Good morning. It's Jeff Christian from CPM Group. It's Friday, the 29th of January, the last business day of the month already. About 11 o'clock, 11:10 in New York. Wanted to talk a lot about silver today. The price of silver obviously rose very sharply on Thursday, the 28th, and then again on the 29th. There are various rumors and theories about what was going on. I would make the point that what we saw and what we have been seeing has a lot more to do with the U.S. economy and political situation and the pandemic than it does with the shenanigans, if you want, of the Reddit group on small cap stocks. Well, I guess they're not small cap anymore. At $13.5 billion. The capitalization of Gamestop is very large, larger than a lot of S&P 500 companies, but the company's not worth $13.5 billion, and nor will the people who own those stocks be worth that much at some point in the near future. I do think that there may well have been some of that involved in silver, but I don't think that that was the major factor that drove silver prices from $25 to $27 and then back down to $26 yesterday. And today it's back up around $27.45 as I'm speaking. I do think that what we're really seeing is, again, the overall economic and political environment and its effect on precious metals. The reality is that gold, platinum, palladium, copper all rose yesterday and are strong again today, reflecting bigger issues than the things going on in the U.S. stock market. Reddit group may have been involved there. There have been some stories about that. It is possible. It's interesting because it does speak to the fact that you can have waves of retail investors drive the price higher, at least on a spike. It's not clear that it can be sustained. There are a lot of other rumors and misperceptions going on in the silver market, which I'll talk about in a minute. I want to kick back to something that is important about silver and waves of investors. Around 2010, there was a guy, company that was creating its own silver ETF, and it wanted to convince small investors that there was a conspiracy. The guy who owned the company and ran the company spent a lot of money supporting people with conspiracy theories on gold and silver. And he started spreading rumors that the major banks didn't really have the silver, and could you really trust major bullion banks with your money? You should trust me instead because I'm a smaller guy. And he was charging about a 25% premium on the silver that he was going to be putting into his ETFs. He also helped finance a thing that was called bankrupt JP Morgan. And the theory was small investors could buy a lot of silver, drive the silver price higher, and bankrupt JP Morgan because in his distorted view of the world, JP Morgan had a massive short position. JP Morgan did have a large short position on the COMEX, but that was a hedge of a large physical position that JP Morgan had, as well as other banks at the time, that was fully hedged on the COMEX. Banks make their money with small fees per transaction, and sometimes not so small fees. Banks are fee generating groups, and many banks and brokerage houses and trading companies have covenants that say they have to be fully hedged with their precious metals in order to have the financing that they use to support their trading operations. So a bank like JP Morgan makes its money in silver and gold by charging fees for transactions. And a lot of those transactions are lending silver and gold to jewelers, electronics manufacturers, chemical manufacturers, catalyst manufacturers, producers, smelters, refiners, the whole chain of maybe 10 different companies that take a metal from being ore into a finished product or an investment product. And that metal is lent out. Lease rates are typically around 3 or 4%, depending on who you are. And The key to understanding bank profitability in metals is to understand that if the price of silver is $5 and I'm charging 3%, I'm earning what, 15 cents on this? But if the price goes to $15, I'm earning 3 times as much, 45 cents. And what you saw was that the price of silver at that time actually rose and rose sharply. And JP Morgan, for its part, was reporting record profits in gold and silver trading. And they were doing that because they don't make money on increases and declines in the gold prices and silver prices. They make money by charging a fee for their transactions. And that fee is a percentage, and at $15 or $30 or $45, that fee is commensurately higher in dollar terms than it was at $5. So you can't bankrupt JP Morgan by driving the price of silver up. Actually, what you do is you generate more profits for it, or for other banks that are involved in that. That's how poorly informed the conspiracy theorists are, and it's how poorly informed the people who drive them are. There's a lot of stuff that's going on, not only in precious metals, but around the world in politics and economics. And you have a tremendous amount of information that is just wrong. And you're seeing that in the Reddit story this week. I happen to believe, and I think that CPM Group's analysis supports this, that precious metals prices have been rising the last couple of days because investors are they're looking at problems with the vaccine distribution system, just failing in the United States and not doing too well in a lot of other countries. And there's a realization that this failure means that you're not going to really be at a place where we can let our guards down till September or even later. And you see The Economist had a very interesting article talking about 2020, late 2021 for some of the major countries, 2022, even into 2023 before some countries get to the point where they can relax some of the restrictions. And that has had a tremendous implication for economic activity and corporate profitability and stocks and bond markets. And I think that one of the things that you've seen over the last couple weeks, well, it's that, and at the same time, there's another factor, which is the disarray within the Republican Party. And again, the headlines are so superficial and there's so much missing the point. But you have a tremendous amount of disarray within the Republican Party. NBC had a great analysis of politics in the United States, where you had about 32% of the people in the middle who call themselves independents or vote independents. And you had about 34% that call themselves Republican and 34% that call themselves Democrats. But then if you disaggregate that, if you looked at the voting trends and how these people self-identify, you realize that about 17% of the Republicans were what they called Trump Republicans, and 17% were what they called mainstream Republicans. And then on the Democratic side, you looked at that 34%, and about 17% were mainstream Democrats, and about 34% were what you could call progressive Democrats. So both major parties are very much divided at this point. And the Republicans having lost a lot, and the Democrats having lost a lot in the House, are all going through this introspection. Republicans, it's a more nasty introspection, and there's a real division there. And you also have some Republican Congress people who are now at risk of not only losing their jobs, but also criminal charges against them because of threats they've made and other hostile things that they've been saying and doing. So you have a Republican Party in disarray. You have a new administration that's changing the way the United States government is behaving. And you have a pandemic where the vaccine program is just falling over itself. We have 9 million people in New York City. This week, we got 17,000 vaccination doses delivered to us. Divide 9 million by 17,000 and tell me that we're going to have herd immunity before the year 2024. Yeah, obviously that's not going to work. And I think the realization of that and the problems within the Republican Party were reflected in higher precious metals prices over the last couple of days. I'm not saying that the Reddit boys didn't have something to do with it. I'm just saying that they're not nearly as important as a lot of people think. Now, moving on to silver, because we do like silver. Silver prices have been strong. They've been strong all year. We've seen a lot of investment demand for silver. Silver demand last year by investors was probably about 103 million ounces, not 304 million, 100 million ounces, the way some guys who don't really know what they're talking about say, but about 103 million ounces of investment demand for physical silver last year. That was 3 times what we saw in 2018 and 2019 when investors were buying 27 or 36 million ounces of silver on an annual basis in those years, physical silver. So you've seen investors get much more keen about silver, and you've seen investors in the futures and options markets and in the ETFs get more keen about silver, and you've seen silver gain relative to gold, not in the last 2 days, but over the last 8 months, and that's probably going to continue. Supplies are relatively tight. They're not so tight that the silver market's going to break the way some people say. Again, there's just this tremendous misunderstanding about how things work that's going on. Silver supplies are tight. Investment demand's on. You have seasonal strength in the first quarter for both investment purposes and also for fabrication purposes. Silver market looks good, and CPM Group is bullish on the silver market on a long-term basis. We expect the price to rise sharply higher from where they are now over the next 3 to 5 years. So silver's a good story. It's not as good as some people say, and there are these people with these incredibly convoluted discussions on the internet about the London-New York arbitrage, which they clearly don't understand what's going on. There's another conspiracy theory that was floating around this week that delta hedging of naked short positions have been dragging this up. And it's not just the conspiracy theorists who misunderstand or do not understand delta hedging and the way the bullion market works. What delta hedging is primarily options and futures. If you are a bank or a trading company or institutional investor, chances are you're borrowing money to finance your trading. And chances are that either your own internal credit department or the credit department of your lending source, where you're borrowing the money, says you have to hedge. So if you have a short or a long position in options and the market's moving against you, you need to hedge that. And if your short or long position is in options, you're going to hedge it by buying futures. No physical metal involved. Sometimes they now use ETFs to hedge, to delta hedge. Sometimes they now use options on ETFs to delta hedge. There's no physical metal involved. And what you're doing is you're buying in. So say that you're short gold, silver, and the price starts rising. You start buying futures to hedge your short options exposure until you're fully hedged. And the delta is that as the price rises, you have to hedge more. We saw this in October 1999 in the gold market. Gold price was trading $255, $260, and it started rising. There are people who think that it rose because they had they had early knowledge of the European Central Bank gold agreement that was announced at the end of September, but that wasn't actually the case. They were rising because October was an actively traded month on the COMEX, and the COMEX was very short. There was one bank that had bought about 40% of the gold registered and eligible inventories at the time. And you had very tight supplies in the gold market. And it was pretty clear that the price would rise into the October delivery period, which it did. It went from 260 to 270. And as it did that, the banks, trading companies, the desks had to delta hedge. They had to trade against themselves. And it's very weird, and you see this not only with banks and financial institutions, you see this with mining companies and oil companies and airlines that have hedged their gold or their silver or their copper or their oil or their jet fuel. And the senior management doesn't understand hedging. They panic and they say you have to cover this hedge because you have a loss. And if they had just waited, what they wind up doing is capitalizing their loss. And if they had just waited, they wouldn't have capitalized their loss and the price came back. So if you go back to October 1999, Friday, the last trading day of September, the price went from $254 to $270 to $274. And it triggered a tremendous amount of delta hedging. The following Monday and Tuesday, the price went from $275 to $340. And the credit departments and the lending institutions forced people to trade against themselves and bid the price up to 340. At 340, they were 100% hedged. And within a week, the price was back down around $300. Had they not hedged, the price wouldn't have gone to 340. And if they had not hedged, they wouldn't have had the costs of going up to buying up to 340 only to see the price fall back more than half of the way that it had risen the week before. So that's how the market works. It's not what you read in some analyses and on the internet. Getting back to silver, it's tight, it's not going to break. A lot of misinformation and bad diagnoses. Yeah, the silver market has cancer when in fact it has a cold. Investment demand is strong, as I said. We are seeing some tightness. US Eagles are on allocation from the mint. Other coins and small bars are relatively tight. There are plenty of big bars around. In fact, there's a lot of them. I want to talk a little bit more about silver. We are going to be having a silver webinar on March 4th, a global silver webinar on March 4th, and we're going to release a booklet. In the past 16 years, CPM Group has hosted a silver reception at the PDAC convention in the first week of March. And at that convention, we have produced a small booklet like this one here from last year. This is the 2020 book that we give out with about 8-10 pages of silver analysis. Can't have a reception this year because the PDAC is going to be virtual. So what we're going to do is a webinar on March 4th, and it's open to everybody who wants to attend. And then we're going to produce this booklet, which will be free. And the silver discussion will be a little bit longer because there's a little bit more to say about what's going on in silver this year. China and India, the London-New York arbitrage, the relationship between silver and gold prices and how silver prices have quantitatively tended to lag in the early days of a bull market, gold prices, but then they play catch up and outperform later in a bull market. And then they outperform, if you will, on the downside after the bull market's ended. So we will be producing this webinar. We are reaching out to distribution outlets. We have several already. China Gold News probably will distribute it in China. China Gold Association wants to distribute it in China. Fortel Business Information and its Bullion Bulletin will distribute it in India. Metals Daily, Kitco, and other outlets. We're looking into how to distribute this and also post our link to the webinar on Bloomberg, and other companies are going to be there. And then after we have a few more of those, we'll start reaching out to sponsors. So this thing is going to go out to about 50,000 or more people, or be available to them if they take it. And that's coming up, and I wanted to point that out. The silver booklet, like I said, it's 10, 12 pages this year, probably, of content. And then we'll put in some more information about CPM Group, its other services, and who we are and what we do, because there are a lot of people who are asking about that, and a lot of people who don't understand it. And then we'll have information on all of the sponsors, the media partners, and the distribution outlets will all be in there too. So the book's going to be PDF, and it's going to be longer than the discussion on silver because it's got a lot of other information. It tends to be a preview of our silver yearbooks, and our silver yearbooks are usually released on the last Tuesday of April. We have congestion in the CPM Group production chain this year. We're very busy on a whole range of issues. So the Silver Yearbook probably will not be released until 28th of May this year, instead of the last Tuesday, instead of the last Tuesday in, sorry about that. Instead of the last Tuesday in April, it'll be the last Tuesday in May. So the Silver Yearbook will be a little bit more delayed. And that's a 250 page book, which has a tremendous amount of data, charts, information, and analysis of the silver market, with data going back to 1950 in some cases, 1977 or so in other cases, and our view of where the market's going to be in 2021. Silver Yearbook comes out May 28th, and the silver booklet that we do at the PDAC on March 4th is sort of a preview of what we saw last year, our analysis of what we saw last year and what we expect to happen this year. So that's all coming up, and we will be sending out information about how people plug into the webinar and how they can score a copy of this booklet. That's all I have for right now. It's been a lot of talk. It's a lot of silver as opposed to gold. We like gold too, but silver is a very interesting market at this point, which tends to be neglected, oftentimes by investors and others. I'll talk to you next week.